Hi, and welcome to Street Smart Options. It's Jim Bunker again with Jonathan Sherman. And today, folks, we're talking about options trading tutorial. So, folks, if you haven't found us yet on Facebook, why haven't you? You can easily go over to Facebook and just punch in the letters SSO, and you'll find the Street Smart Options group on Facebook. You do have to ask to join, but feel free to just go ahead and join. It's 100% free. You get great information like what you're going to be hearing on today's video. Go ahead, Jonathan.
Yeah, so today we're going to go over some options trading tutorial information, and I'm going to start pretty simple. I'm going to assume that people listening to this are learning, maybe they're early on in their learning stage about stock options. So to make things straightforward, first I'm going to go into what is a call and what is a put option. And so we're going to go take a look at something called an options chain, and we're going to explain what an option is. Well, people, one way to think about options is you can buy it you can buy alongside call. See, there's calls here, and you can buy alongside call instead of buying the stock outright. And so if you wanted to make money from a stock, you would just buy it in the marketplace. The stock would go up, hopefully, right? And you'd earn some dividends and some stock appreciation. And then maybe one day you'd sell it, or if you're a long-term investor, you'd hold it for a lot of years and then sell it. Now a stock option doesn't quite work that way, because stock options have limited lifetimes, right? So if you were to buy, for example, this stock option right here, which happens to be, and I'll explain this in a minute, happens to be the 140 strike stock option on Johnson and Johnson, you would pay $175 for this option here, and that would give you you'd be controlling basically 100 shares with that purchase. So if the stock price goes up, say it goes to 150, right? It's right now trading at 138.80. Say the stock price goes to 150. Well, then you're in the money by 150 minus 140, which is $10, right? And so this price here would be showing at least $10 plus some time premium, and so you'd be making money. Or if the stock goes down, then and doesn't include, and the option expires, and this is the expiration date, when it actually stops trading, June 28th, right here, and there's all these different expiration dates. Then you're going to lose what you put in, the $176. You'd be out 100% of your investment, right? And that's why stock options have this reputation as being really risky, because you can lose 100% of your investment. Now, the thing about buying just let me cover what this strike price thing is and what all this means. Now, options trade with different expiration dates, right? And so there are weekly options on the heavily traded stocks, like this is Johnson & Johnson. So each one of these options stops trading on one of these days, June 14th, June 21st, June 28th, and this is the number of days, 7, 14, 21 until expiration. And of course, there's all these other options you can purchase, and some really long dated options. Like here's the longest dated option is the January 15, 21, right? That's almost like buying the stock outright, because if you were to buy a deep in the money call option, if you were to buy I don't know how deep these strikes go on Johnson and Johnson. So let's say we were to pull up that option just as an example. Let's see. Let's pull up that November, and we can look at, we could buy the 70 here, and that would be in the money by $68, right? And so it's almost like buying the stock at this point, because this doesn't expire until November 15, let's say January 17th, 20, right? So that's a really long ways away. So you wouldn't have to worry too much about the expiration date, but you're certainly paying a premium for the stock option, because if you look at the price, 138.78, and say you were to buy the 70 here, well, 138.78 minus 70 is 68.78, right? And so you would be paying 69.80 for this thing. And so, you're paying an extra, what is it, $1.50? It's not much for the time premium, for the advantage of not having to buy the stock outright. You pay this little premium. which goes to zero. That premium goes to zero, not the option, as the expiration date approaches. So that, as it may, so that's certainly one way you can invest less in Johnson and Johnson by just buying this long dated stock option. And now puts are the opposite of call options. Call options go up if the stock goes up, right? And with a put option is basically giving you the right to sell a stock at a certain price. So a call option, you have the right to buy this thing at $70. But with a put option, you would have the right to sell it at $70. So obviously this $70 option is worthless, right? Because options don't go negative, and so 70 minus 138.79 is a big negative number, and so it's a worthless option. So you would be just paying time premium here, and with a put option, you're wanting the stock to go down, and so you're thinking that, oh, this thing, Johnson & Johnson, the market's going to crater. Johnson & Johnson has some big blow up or whatever in the long future, and I'm going to speculate, right? This is a very speculative position, and you'd likely, most out of the money call options, most out of the money options like this expire worthless. So anyway, so options have they expire at a certain date, and then they have a strike price where that's how you derive the intrinsic value of the option, by taking the stock price and with the call side subtracting the strike price to come up with the value. And then there's also, like I said, there's time premium. So if there's a lot of time before the thing expires, they're going to be trading for more money. So now, why would you want to own, this may be this little bit of confusing, the stock option here. So let's go back to where we are, a closer dated option in here, and let's look at the June. Maybe we'll go to the July 19th call option on Johnson & Johnson. Now, the one thing I want to say is, when you get into trading stock options for the first time, I would focus on the long side options first of all, and find a stock you wouldn't mind owning. You wouldn't mind owning. And so Johnson & Johnson is one of those stocks you wouldn't mind owning. Now, like I said, you can buy those really deep in the money, long dated options that I just showed you, and you'd be spending less money. Your capital invested would be a lot less, right? Because you're with these like the January 15, 21, right? You're spending only 70. You're spending for this long dated option here. You're spending $7,140 to control 100 shares instead of $13,880 to control 100 shares. So you're spending half of what you'd have to spend to control 100 shares, but you're making the same amount of profit if the stock goes up. But you're not getting the benefit of any Johnson & Johnson dividend in this case. That's certainly one way to trade options more safely, is just to go these long dated, long expiration kind of trades, and deep in the money, long dated trades. But what I'm going to talk about is something that is maybe a little bit faster return, that has is perhaps a little safer. Now, the Johnson & Johnson, because the type of company it is, it's a big S&P 500 company. It is a relatively stable company. It's not like Band-Aids are going to stop selling soon, right? And they control a lot of major brands like that, and it's the consistent revenue, and it's a major company in the United States, well, worldwide, but it's based in the United States. So what you can do is, with a kind of company like Johnson & Johnson, there's two strategies. You can own the stock outright and then sell call options against it. So, for example, if the stock is trading at 138, if you own the 138 stock, you can actually sell. And we're in the July 19. We're in the July 19 expiration dates here. So if you were to buy the stock outright, and you don't know if the stock's going to go up a lot. Probably, in 2 months it may go up a lot, may not. It's Johnson & Johnson. It's not flying, right? It's not a super fast moving stock. But you can sell this call option against your stock. It's called a covered call position. And you would make, in this case, you'd sell it for $2.94 or that's 294 for every 100 shares that you own. So you own 100 shares of Johnson & Johnson at 138.80, and basically every 6 weeks here, right, you can sell and make $300 essentially on this stock. So it's like getting a synthetic dividend, right? Because this will expire worthless, this 140 strike, if this thing closes under 140. And so you'll collect that, and there's no risk with you actually selling this call option here against the stock. The only risk is owning the stock, right? So if the stock goes down a lot, you're going to be out the money in the stock. But if you really like the company and you want to hold it long term, that's one strategy you can employ to improve your returns. You sell these call options to earn a synthetic dividend, because these out of the money call options expire worthless unless the stock goes over this amount. Now, what happens if it goes over? Well, then you don't care. You still make your $300 here. But what's going to happen is that expiration, the call is exercised, and so you own the stock. You actually end up selling the stock at 140, and so you would then lock in the capital gain, 140 minus 138.81, which is about $1.20, and plus the $3, and so you're at $4.20 roughly, right, minus commission. So you've made $4 in about 6 weeks on Johnson & Johnson in a pretty safe trade. Now, the other thing you can do with Johnson & Johnson, now understand, when you buy this stock and you sell this call option, which is what I'm recommending for like maybe somebody who's just starting out, this kind of trades you probably want to do. You're at risk for the stock going down. Well, it turns out that's the same thing. That is the same exact thing as if you didn't own the stock at all, and you didn't sell the call against it. Instead, what you would do is you would sell the put option. So it's called selling naked puts. Now, it's basically the same thing as buying the call, as owning the stock and selling the call. When you sell your naked put, right, you're collecting your premium. In this case, you're going to sell it for $3.80. But you're subject to the stock falling. So if the stock falls out of bed, there's unlimited downside till this thing goes to zero. So while you're pocketing $380, you're at risk of losing. If this thing went to zero, you're controlling 100 shares, you're at risk of losing $13,876, right? So it sounds really scary and all, but really, it's the same thing as owning the stock. If you own the stock, you're at risk of losing $13,876. The same exact thing as owning the stock as selling the naked put, right? As long as you don't go crazy and sell a whole bunch of these naked puts, it's the same thing. So if you were to sell one contract which controls 100 shares, it's essentially the same thing as buying the stock and selling the call option. So your broker is going to hold, and because this is going to be like a margin account, the broker is actually going to hold this $13,800 as collateral for this position. And so it's going to limit the amount of money you have available to make other trades. But it's the same exact thing. So I just wanted to make that point. You can sell naked puts on stocks you really want to own, or you could buy the stock and sell the strike and sell the call against it, right? And so now how do you figure out, what's my potential annualized return on these things? Well, there's a calculator we have on Street Smart Options, and it is a calculator that basically tells you for various trades what your potential return is. So, for example, if you're writing the covered call with Johnson & Johnson, you would put in your portfolio. Say you have a $100,000 portfolio, and then you could put in how much you want to risk on owning Johnson & Johnson. So say you want to put 10% of your portfolio in Johnson & Johnson, right? And maybe you want a stop loss on Johnson & Johnson of 10%. So if the stock goes down, you don't want to own it to zero, right? And you could get out of it at 10% loss. And then you put in your stock price, and the stock price was about 138. And this is just an example, so I'm not going to put in the exact thing. I'm not quite sure dividend yield, so I'm just going to leave it at 1%. Probability of exercise is just what's probability that thing is going to go up over your strike price. Today's date is 06/07/2019, and the expiration on that was, let's see what it was, Okay, so we have our July 19 option here, and we're going to sell the 140s. And so we're going to put in July 19, and the 140s are 293. So we'll put in the July 19 in our calculator. And the stock price is 138. It was 70, about 75, and the strike of the option is the 140, and then the price is 2.93, right? And so it's telling us here that with 100,000 portfolio, we can't actually enter this trade with the max position size of 10%. So we got to increase the size of our portfolio to actually do this with a 10%, with max position size of 10%. So let's do that. So with a $500,000 portfolio, you can buy 300 shares and you would sell 3 contracts against it, and your annualized return is 22%, which is pretty good for a nice safe trade that you can repeat every 6 weeks. You're going to make 22% annualized gain. So that is basically the options trading tutorial we're going to go through today. If you're just starting out, focus on long side trades you wouldn't mind owning, and focus on just buy rights like I showed, or just selling naked puts on types of stocks that you wouldn't mind owning, and you can control your risk and come up with these decent gains, annualized gains, which is more than Johnson & Johnson probably return if you were just owning that stock outright. Okay, Jim, back to you.
All right, Jonathan, thanks for that. So, folks, if you're not seeing videos like this on a regular basis, that might mean that you're not subscribed and you haven't hit the bell icon over on YouTube. So if you're watching us on YouTube right now, give some thought to hitting that subscribe button. If you enjoyed the video, give us a thumbs up. We always appreciate any comments that you'd like to leave for us here on our channel. And if you do subscribe, you risk less of a chance of missing great videos like this from Street Smart Options. You can also always visit our website at streetsmartoptions.com, where if you're interested, you can definitely sign up for our program as well. Thanks.